Okay, everyone, what's going on? It's Steven. I got a fun one today. A lot of people, a lot of people take the information that they see about the stock market, and that's all they do. For example, we're talking here about doubling the Apple dividend, and obviously, a lot of people invest in dividend stocks and like to collect dividends for a lot of different reasons. And there are merits to do it for people who are looking to generate cash from their investments. A dividend is one of the ways you could do it. Maybe people who are a little bit older in their life that are living off of their dividends, well, that's definitely something that can bring in cash as well. But this is a really good example of obviously we're going to talk about doubling the Apple dividend. We're going to talk about that, and you're going to be able to go out there if you're a shareholder of Apple or any other dividend stock and do this exact same thing literally the next day the market's open after you're following this video. But the dividend's nice, but in investing, there is always a better way. There's always something small that you can add to all your investments to really turbocharge everything that you're doing, to really add to what you're doing. So a dividend's nice, don't get me wrong. Apple pays right now, as the time of creating this video, Apple pays a $2.52 dividend. Okay, that's great. It's free. You do zero work for that. But again, like most things in investing, you don't want to stop right there. Okay, you don't just want to collect a dividend and go and be happy about it. There's always more you can do, and most of the time, the extra things that you can do don't really take a lot of time, effort, or money at all. In fact, doubling the Apple dividend here in this video, which we're going to show you, costs nothing. Maybe takes 30 minutes over the course, 30 seconds over the course of an entire year. So tune in, we'll get to that right here. So first of all, what is a dividend? Well, you know what it is. Everyone knows what a dividend is, so we can go ahead and skip that. If you don't know what a dividend is, I recommend that you go out there and you search into YouTube or Google what a dividend is. We're not going to cover that right here, right now, because we want to kind of jump into everything. So you came here because you want to learn how to double the Apple dividend. Well, let's get into it. So as of writing this presentation, okay, Apple, the largest company in the world, sells iPhones, sells Macs, all that stuff, apps on the phone, is currently $174.14 per share. Okay, that's what it is. Now, the dividend, okay, is $2.52 over the course of the next year, which means you will get 4 payments once every single quarter of 63 cents per share. And right now, with the price of the stock being $174.14, that comes out to be an additional 1.45% on your investment over the course of the year. So if you hold Apple, assuming they don't raise or decrease their dividend, if you're a shareholder of Apple, you'll get 63 cents per share credited directly into your account 4 times over the next year, which will end up being, again, $2.52 over the course of the next year. Again, now that is the dividend. Okay, that is the dividend. But like I said, in investing, and especially in the whole dividend space, there's so much more you can do. And in fact, you can double it with just a few seconds over the course of the next year. So again, there are a lot of reasons why people get into the dividend game. There's a lot of reasons why people like to buy and hold and own dividend stocks. First of all, people like getting paid cash. People like getting paid cash. If you own 1 share of Apple, you'll get 63 cents directly into your online brokerage account 4 times over the year. Now, obviously, as you have more shares, that price goes up. But for every share, you're going to get 63 cents in cash into your account. So again, people like that. And again, if you're a believer in a company like Apple, or really any other company that does pay a dividend, well, people feel better about the investment because maybe things don't work immediately. Maybe there's a little bit of price fluctuation, but they know that the company is good, the dividend is solid, so they're happy to wait for the stock to come back up or to go higher, and in the meantime get paid to do so. And again, that totally kind of makes sense. And again, like we're kind of mentioning with everything else, people like that income in their account. People love that income in account. You make money on the stock if it goes up. You lose if it goes down, but at the end of the day, you still get that income in your account, okay? But again, like I kind of mentioned before, okay? If you like the income, if you like getting paid cash, if you like getting paid to wait, then why stop at the dividend? I understand that with the dividend, you buy once, okay? And when you buy once, you do nothing. The dividend comes your way. But what if you could do one thing that doesn't cost you anything, that takes 30 seconds to do over the course of the next year, that brings in double the dividend? I mean, would you be interested in something like that? Of course you would. Again, to put in 30 seconds more effort to double the dividend, I mean, obviously, that is something you'd be very, very interested in. And it's not very, very hard to do, and anyone could do it. Again, investing, if you put in a little bit more effort, you get huge, huge, huge returns. So, what can be done here? Well, another way to add to our dividend, okay, is to sell one call against every 100 shares of stock we own, okay, called a covered call, okay? And this will allow us to immediately collect the credit for doing so. So the difference here with selling a call against our stock is with a dividend, we get paid out no matter what 4 times a year. Okay, so if there's a $2.52 dividend like there is in Apple, we're going to break that up into quarterly payments of 63 cents over the course of the next year. However, if we sell a call against our stock, we get that credit or money immediately. Okay, so again, once we sell that call against our strike, we agree to sell stock at that price at a predetermined date. Don't worry, we're going to get into that in a second. But the thing you need to know is obviously with the dividend, you get that money over the course of a year in 4 quarterly payments. If we sell a call against our stock, we get a credit, a payment into our account immediately. We don't have to wait a year for that. So let's take a look and see if we can double the dividend using this simple strategy. And again, this strategy takes 30 seconds over the course of the next year. So let's double it, shall we? So if we want to go ahead and double our Apple dividend, remember, right now, as of recording this video, Apple creates a dividend, pays out a dividend of $2.52 over the course of the next year. So if we want to double that, we want to make that around about $5.04. So what we would need to do is we would need to sell a call, okay, for every 100 shares we have that is equal to or very close to $2.52. So if we sell a call that has a value of $2.50, again, we get that money, that $2.52 per share in our account immediately. So if we sell a call that's equivalent to $2.52, and then over the course of the next year, we get another $2.52 in the form of 4 quarterly dividends, we have synthetically or in theory doubled the dividend to over $5. So right now, as of recording this video, again, Apple is what, 174.14. The yearly dividend in Apple, $2.52. Right now, the January options expiring a little bit less than a year, so 281 days from now, the 215 call option, as we can see highlighted with the red arrow, is trading for about $2.69. So obviously a little bit more than $2.52, but it was the closest one that would allow us to double our actual dividend. So if we were to go ahead and sell that $2.15 call, we would immediately collect that $2.69 per share, and we would get that into our account immediately. Now, here's the thing. When you sell a call against your stock and against 100 shares of stock, you are agreeing to sell, okay? You are agreeing to sell your 100 shares for $215 a share if in 281 days from now, the price of Apple is above $215. So that's the only caveat here is, again, you will get that dividend immediately, but you will have to give up those shares if they're over $215 a share. However, it's not really the end of the world because let's break it down to pure numbers. So if you buy Apple at $274.14 and you just collect the dividend, in both cases, you're going to get that $2.52 over the course of the next year, no matter what, unless the company removes the dividend, decreases it, increases it, whatever it is. But if you just harbor the dividend, Okay, if you just harbor the dividend, you get no extra credit for selling a call. You get no extra credit. Okay, so your total credit received over the next 12 months, if you just buy the stock and collect the dividend, is just $2.52 a share. Now, on the flip side, if you're to buy it and sell that $2.15 call, okay, not only are you going to get that $2.52 dividend over the course of the next year, but you're also going to get that $2.69 immediately today for selling that call against your 100 shares of stock. So we have now increased the dividend, the credit we receive over the next year, from $2.52 to $5.21. So with Apple being $174.14 over the next year, instead of getting paid out 1.45%, we're getting paid out 3%. Now, what's really interesting about this is a dividend and selling the call, they're both receiving a credit. You are getting money credited to your online brokerage account when these events happen, whether an ex-dividend day comes or you're selling that call. So over a 12-month period, if you were to buy Apple right now at $274.14 and collect that dividend, you would be reducing your cost basis over the next 12 months because, again, you're collecting that credit from 174.14 to 171.62, reducing them by 254. And at the same time, if you were to get that dividend and sell that call, you would be reducing it by even further, so all the way down to 168.93. Again, think about it this way. Apple trades at 174.14. Who has a better chance of making money? Someone with a cost basis at 171.62 or someone with a cost basis at 168.93? Okay, obviously the one with the lower cost basis. Now, here's the thing. Here's the reason why people don't like to do this, but I highly, highly recommend that you do it. Your maximum upside is not limited unless you sell the call. In this case, if you want to double your dividend, and instead of collecting $2.50 over the next year, you want to collect $5.21 per share, you will max your upside at 23.46%. Now, here's the thing. Would anyone not be okay making 23.46% on their Apple investment over the course of the next year? And at the same time, on top of that, collect $5.21 per share, which is guaranteed? Okay, I would love to do that, especially the fact that as of right now, Apple is over $900 billion of market cap. So you're not really going to have to sell this until Apple's market cap is about $1.2 trillion. So to me, I would any day of the week take the dividend and the covered stock for a few reasons. Number one, I'm collecting more credit over the course of the next year by a factor of twofold. Number two, my cost basis is reduced more to 168.93. Okay, and at the same time, I am okay giving away my 100 shares of Apple 23% higher because I know I've collected the most amount of credit, and at the same time, the lower the cost basis, the better chance of making money. So again, the proof is in the numbers. I've been in this game for well over a decade now. Any time, any single day of the week, I would be doing the dividend and the covered stock. No questions asked. So let's see what the takeaways are. So if we sell a call to cover our stock, that is equal to the value of the yearly dividend. So if you remember, in this example, we sold that first call that gave us close to $2.52 per share. So if you go ahead and do that, in essence, we double our dividend because we double the credit we receive over the next year. And this not only allows us to bring in more cash, right? It allows us to bring in, let's see, 521 over the course of the next year as opposed to 252, but it also allows us to lower our cost basis than compared to just owning the dividend. And the person who has the lowest cost base has the greatest chance of making money. Now, at the same time, the upside is limited when we sell our call. But for cash generators, we recommend selling the call against your stock while at the same time collecting that dividend. Remember, over the course of the next year, you are doubling the amount of cash you generate. Now, as an investor, again, with over a decade of experience, I would take the cash, okay, the lower cost basis, and the limited upside any day of the week because, look, there's no guarantee Apple is going higher. There is no guarantee Apple is going higher. However, if I sell the call against my stock, there is a guarantee that I will have a lower cost basis, and there is a guarantee that I will collect more credit. And those things I would much, much prefer because, again, the price of Apple is not guaranteed. But having a lower cost basis and bringing in more credit over the course of the next year, that is guaranteed. So guys, if you're someone who likes dividend stocks, okay, whether you're living off of the dividend or you like generating the cash, I highly, highly, highly recommend that you take that extra 30 seconds and cover your positions by doubling that dividend. It will allow you to reduce your cost basis by double over the course of the next year, and at the same time, it will allow you to double the cash you're bringing in. So go out there, guys, take some action, and I'll see you guys in the next video.